Donald Trump has picked trade fights on nearly every front: India, China, Russia, and now the European Union, selling it as a show of strength. But behind the headlines, the picture is very different. Factories are scaling back, payrolls are thinning, and managers say tariffs are driving up costs that eat into already thin margins. What's presented as toughness abroad feels like mounting pressure at home, with no release valve in sight. Tariffs have also become a budget crutch. Revenue from duties is rising, but the deficit grows even faster, swallowing those gains almost immediately. That's why the White House keeps leaning on the Federal Reserve for cuts. With rates high, interest costs swell, and cracks in the fiscal wall show up directly in the monthly cash flow. Meanwhile, BRICS capitals are moving in another direction. They're laying track: new settlement systems that bypass the dollar, deeper gold reserves, more trade in local currencies. It's methodical work, quiet but decisive, while Washington sprints from one crisis to the next. That's the frame for today's story. We'll unpack how tariffs turned into a revenue addiction, why manufacturers are struggling under higher input costs, how debt and interest have boxed policymakers in, and what BRICS is building while the US argues with itself. By the end, you'll see why the balance of power in global finance is shifting. Quietly at first, then all at once when confidence moves. So let's begin with the first piece of the puzzle: the trade war itself. Donald Trump already has tariffs running against India, China, and Russia, and now he is pulling the European Union into the fight as well. It's a strategy that stretches America's resources across too many fronts. Beneath it all is a clear objective: weakening BRICS, the group steadily building influence outside Washington's orbit. For his administration, tariffs are more than political theater. They have become a crucial revenue source at a time when the deficit keeps expanding. Billions are collected from duties ranging between 10 and 50% on imports, yet the math doesn't work. The gap grows far faster than tariffs can fill. It's like trying to hold back a leaking dam with buckets. The inflow is simply greater than the outflow. Officials in Washington insist these measures aren't fueling inflation, yet the evidence is in plain sight. Grocery bills, factory supply costs, and business invoices all show the same pattern: rising prices. Families feel it at the checkout counter, and companies feel it in disappearing margins. Tariffs were meant to squeeze foreign exporters, but the costs are circling back into the US economy, leaving Americans to pay more for the same goods. Meanwhile, competitors are moving in another direction. Beijing is pouring capital into high-speed rail, new energy technology, and industrial hubs designed for decades of growth. New Delhi is carving out trade corridors across Asia and Africa. Moscow, pressured by sanctions, has shifted exports toward markets that remain open. Each is adapting and creating resilience, while Washington leans harder on taxation through tariffs. This contrast is stark. America is chasing quick cash, while its rivals are laying foundations for long-term strength. The consequences of that choice are beginning to show, and the gap will only widen if strategies remain unchanged. That gap is most visible on the factory floor. For years, Americans were promised that tariffs would protect jobs, bring back production lines, and rebuild the country's industrial base. On the surface, it sounded like a path to renewal. In practice, the picture is far bleaker. Plants are scaling back instead of expanding, and just last month alone, more than 12,000 manufacturing jobs disappeared. Each of those figures represents families without income and communities losing the anchor that kept their local economies alive. The data from the Federal Reserve confirms this strain. In Texas, the Dallas Fed found that more than 71% of manufacturers are seeing their costs rise because of tariffs. The pressure comes from two sides: higher bills for raw materials like steel, aluminum, and electronic parts, and weaker demand from customers who are pulling back on spending. When costs climb and orders fall at the same time, the result is predictable. Plants shorten hours, then cut jobs, and in too many cases, shut down completely. This is not an isolated trend. Manufacturing's share of the US economy has been steadily eroding for decades. In the late 1990s, it made up around 16% of total output. Today, it hovers closer to 10%. Behind that number are shuttered auto plants in Ohio, steel mills gone quiet in Michigan, and abandoned warehouses in Pennsylvania. What was once the industrial belt of America has become a patchwork of hollowed-out towns where the next generation sees fewer opportunities than the one before. Even efforts to bring production home have fallen short. Apple still assembles the vast majority of its iPhones abroad, and Tesla's much-touted battery plants rely heavily on imported components. The challenge is twofold. The cost of producing at scale in America is high, and many industries lack the skilled workforce to grow quickly. That shortage of talent is now one of the biggest obstacles. Years of decline have left fewer young people entering trades, training programs are limited, and older workers with valuable skills are retiring. Today, the United States faces a gap of roughly 400,000 factory workers. Even companies that want to expand struggle to find welders, machinists, and engineers to staff production lines. The effects ripple through entire communities. A single factory supports not only its employees, but also trucking firms, suppliers, restaurants, and local schools through tax revenue. When jobs vanish, the damage spreads outward. Businesses close, schools lose funding, and crime often rises in places where opportunity has drained away. While the US wrestles with these setbacks, others are accelerating. China now produces more than a quarter of the world's manufactured goods. Its plants are expanding, its workforce is being trained, and industries from steel to advanced batteries are scaling up. Washington, meanwhile, is still debating tariffs and infrastructure bills. This is why prices keep rising, why industrial towns feel emptier, and why the promised revival of American manufacturing never seems to materialize. The foundations of the system are weakening, and unless there is a serious shift in strategy, the gap with global competitors will continue to widen. And the pressure doesn't stop at the factory floor. The deeper you look into America's finances, the more fragile the picture becomes. Deficits are swelling at a pace that alarms even seasoned economists, and with every passing month, the cost of servicing that debt grows heavier. Interest payments alone are taking a larger share of Washington's budget, leaving less room for anything else. This is the backdrop to the White House's relentless calls for the Federal Reserve to cut rates. Officially, it's framed as support for growth, but the real motive is keeping debt costs from exposing how unstable the system has become. The numbers speak for themselves. Tariff revenues, even at record highs, barely make a dent compared to what is owed. Every dollar collected from imports is overshadowed by billions spent on interest, leaving Washington desperate for relief. If the Fed holds firm and rates remain elevated, the cracks will be impossible to hide. Markets will see deficits growing faster than the economy, and the myth of stability will collapse. Confidence can shift quickly once investors realize the cushion is thinner than they were led to believe. Meanwhile, BRICS countries are taking the opposite approach. Instead of relying on emergency measures, they are gradually insulating themselves from shocks. Reserves are being diversified, regional payment systems are taking shape, and exposure to US debt is shrinking. These steps don't dominate headlines, but they build steady resilience. While Washington scrambles to buy time, others are preparing to outlast the storm. The contrast is clear. One system is patched together to survive another year, the other is laying foundations to endure for decades. And in the long run, it is usually the patient builders who end up with the stronger position. But tariffs and debt maneuvers weren't the only tools on the table. When those proved insufficient, the White House shifted to another lever: weakening the US dollar. The idea was simple. A cheaper dollar makes American goods more competitive abroad, giving exporters an advantage in global markets. Central banks worldwide quickly noticed, and some began considering similar steps to defend their own trade positions. On paper, it can look like a clever strategy. In practice, the costs at home are steep. A weaker dollar reduces what families can buy with their savings. Imports rise in price, and when tariffs are already inflating the cost of foreign goods, the effect compounds. Electronics, clothing, household items all become more expensive, while paychecks stretch less each month. For ordinary Americans, that translates into tighter household budgets and a real decline in living standards. This policy also erodes the very trust that gives the dollar its global weight. Washington insists the world keep relying on its currency, even as it deliberately devalues it. Trading partners are left to question why they should hold faith in something its own government is undermining. That uncertainty has opened doors for others. BRICS nations are expanding settlement in local currencies, accelerating plans for alternative payment systems, and trimming their exposure to the dollar. Each time the US dollar is devalued, the incentive for others to move away from it grows stronger. What was once seen as a secure foundation of global commerce now looks less certain. Trump may see a weaker currency as a way to prop up exports, but the unintended consequence is far larger. It chips away at the core of America's financial influence, the global confidence in the dollar itself. That confidence took decades to build, and once it starts to slip, restoring it becomes an uphill battle. And while the dollar's foundation shows cracks, another force is quietly gaining strength. Beyond tariffs, deficits, and currency maneuvers, a different trend is reshaping the financial landscape: the global rush into gold. Nations are steadily increasing their reserves, treating gold as a shield against volatility and political risk. Among them, BRICS countries, especially China, are leading the charge. Beijing has been buying gold at record levels, building a buffer that doesn't rely on the dollar and cannot be undermined by outside pressure. Washington, by comparison, has been slower to act. Only recently has the US begun to recognize that the supremacy of its currency is no longer guaranteed. By the time policymakers started discussing how to safeguard the dollar's role, BRICS members were already far ahead, laying the groundwork for a system that doesn't lean on America's financial institutions. Gold plays a central role in that strategy. It isn't tied to Federal Reserve interest rates, and it can't be undercut by political decisions or sudden policy shifts. It offers stability in a financial world that often feels unstable. This contrast reveals two very different approaches. Trump's team has relied on quick maneuvers: tariffs for revenue, dollar devaluation for trade, pressure on the Fed to ease borrowing costs. These are short-lived tools, ways to buy time without solving deeper problems. BRICS countries, meanwhile, are thinking decades ahead. They are broadening trade in local currencies, securing gold reserves, laying trade corridors across Asia, Africa, and Latin America, and experimenting with financial systems designed to bypass Western control. Reports even suggest they could introduce a common BRICS currency by 2026, backed in part by these growing reserves. This steady preparation is why America looks increasingly overextended. It is fighting on multiple fronts, leaning on tariffs to plug budget holes, manipulating its own currency, and pressing its central bank to keep rates low. Its rivals are quietly building resilience, step by step, bar of gold by bar of gold. The question is no longer whether the world is changing, but whether the US can adapt quickly enough. Will it maintain its dominant position, or will it exhaust its strength in short-term battles while others build a stronger foundation for the future? For clear analysis on where these shifts are heading, subscribe and turn on notifications. The world is changing fast. Don't get left behind.